Hello, and thank you for joining us for our third quarter economic and market update. I'm Tom McKinstry, head of investments at Main Street Advisors, and I'm joined here today with my colleague Tony Alquette, who is fixed income manager at Main Street. I will kick off the call with a brief review of our 10-topic agenda, and then we'll dive right into fixed income focused topics with Tony. We've designed the call to cover 10 prominent themes in the economy and markets. We'll show a slide for each topic and then provide a few minutes of commentary to frame out some of the more important concepts. A first rundown on where we stand in the markets year to date through yesterday, October 22nd. The S&P 500 is up 15% in total returns. Total return terms. The NASDAQ a little bit better at 18%, and the Dow Jones Industrial Average a little weaker at 11%. The small cap Russell 2000 is also up 11%, and international equity markets, as proxied by the MSCI ACWI ex-US index, have gained 29% year to date, and they have been boosted by US dollar weakness and a surprising market recovery in large markets like Germany and China. On the fixed income side, the US aggregate bond index is up about 7.5% year to date, supported by healthy coupon income, alongside a bit of price appreciation due to a moderate decline in yields. And finally, gold is up about 55% year to date, with a substantial acceleration in recent months, as retail investors seem to have put a bid under the precious metal after a 3-month consolidation period around $3,500 per ounce. So with that, let's jump right into our first topic. Tony, we have seen some softening in the labor market in recent months, and we're now flying a little blind with government job data over the last 3 weeks unavailable due to the shutdown. How do you assess the state of the U.S. job market?
I think the word to describe the U.S. job market currently is precarious. We've seen hiring slowdowns, layoffs that have very moderately ticked up, and a slowly, steadily rising unemployment rate. As you can see in the chart here, we've seen unemployment remain more or less range-bound in the last 15 months or so. And that seems to fly maybe in the face of slowing down hiring and increased layoffs. But, I think the reason for that is largely due to the makeup of the workforce. So, we've seen immigration really accelerate the year 2023, 2024, and that's kind of unwound a little bit this year. The labor supply growth sort of reflects a lot of re-entrance into the market, people who hadn't been looking for jobs for the last couple of years, people who'd stepped away from the market for whatever reason are re-entering the market slowly but surely, and that seems to be behind a lot of the increase in the unemployment rate, such as it is. The one thing not necessarily directly shown here, we've seen payroll growth fairly tepid relative to inflation. Wage growth hasn't accelerated significantly. It hasn't depreciated significantly, particularly as it relates or it compares to inflation. We've seen companies be fairly cautious with adding headcount and a sort of stable demand for labor. The labor market, in summation, is cooler than it was a year ago, but I think the fact of the matter is it's cooling, not collapsing entirely.
All right, excellent. Next, there's been plenty of angst about the potential for tariffs to cause an acceleration in inflation during the second half of 2025. And in the official numbers, and we're going to get, I think, a delayed September CPI report on Friday, the 24th, tomorrow. In the official numbers, we haven't quite seen that yet. How are bond market participants pricing long-term inflation, and what's your take on the inflation question?
Market-based inflation expectations have remained fairly sticky in spite of labor market cooling. We see 2, 5, and 10-year TIPS break-evens all above 2%, kind of in that 2.5% range. It sort of reflects an asymmetric view of inflation risks, with some potential for renewed upside to inflation, or potentially success from the Fed in being able to choke it down lower under 2% or back towards 2%. There's concerns in the market about the impact of tariffs, wage pressures, particularly as they were compared to inflation, and the Fed's ability to achieve price stability at their target level of around 2%. Longer term expectations are a little bit more in check than shorter term, as you can see from the chart. The darker blue line being around the 2-year break even being the highest, sort of reflects an uncertainty about the immediate future, while the 10-year green line break evens are a little bit lower, sort of suggesting there's confidence the Fed will get there eventually, even if they aren't quite there now. I think the other thing sort of shown by this with twos, fives, and tens sort of lined up the way that they are suggests that there's a gradual path back towards the target of 2%, not necessarily an expectation of a sharp disinflation or a recession or anything along those lines.
All right, well, you brought up the Fed, so here we go with the Fed slide. Our central bank's dual mandate is full employment and price stability. We just covered both of these topics. How do we think about Fed policy at this moment in time heading into the final week of October?
I think the main thing that we need to do here, this chart kind of shows, is listen to the Fed. They've preached patience, they've preached data dependence, and currently we're seeing markets pricing in 5 rate cuts or so by the end of 2026, which is an effective rate of around 290. The Fed dot plot recently, while a little all over the place, does show an estimate for about 340. So kind of a 50 basis point spread there between what the Fed is calling for and what markets are expecting. I think the Fed has been pretty clear about their path. And as you can see from the chart, markets have been a little bit optimistic in trying to get ahead of that. I think the disconnect as well, maybe is an investor attempt to front run not necessarily a pivot in policy, but an acceleration out of being patient and data dependent and wanting the Fed to kind of declare a victory on the war on inflation. Ultimately, there's kind of a volatile outlook here. Markets are expecting pretty heavy easing. The Fed's been preaching patience, which would suggest a higher for longer approach. And it's something that we're going to have to wait and see into next year.
And just to be clear, it looks like the market's pricing in about 100 to 125 basis points of rate cuts from here through the end of next year, 2026. I think if the president had his way, we'd be lower than that. So we'll see
It's a good point.
how things turn out.
No, it's a good point. Especially with Jerome Powell's term ending next year, the president's been pretty outspoken about wanting rates to be lower and thinking that the Fed should cut rates pretty drastically. As he's appointing the next Fed chair at that time, I think it's probably conceivable that he'll appoint someone who's in line with his views. But obviously, it's voted on by the Board of Governors, so it's going to be on the next Fed chair to convince everyone that to come around to that point of view.
Well, I just want to know if Trump's going to go to Jay Powell's retirement party in May of 2026. He might not.
At this point, I would guess no.
All right, moving on. We're gonna go a little bit under go down a layer or two in fixed income markets. We spend a lot of time thinking about the structure of interest rates in the market. For a long time, things were a bit upside down, with short-term yields higher than their long-term counterparts. But things have changed over the last year or two. We've got some normalization at hand here. Could you please explain what's going on with the U.S. Treasury yield curve, and then what's this concept of the term premium?
Sure. So, as you can see where we were at back in March of 2023, which was, around the peak inversion of the Treasury curve measured by the 2-year spread to the 10-year in terms of yield, to now where, we're a little bit more normalized, where outside of the first, 12 months or so, you're getting a little bit more yield for going out further on the curve. And that's really a sign of a healthier Treasury curve, generally speaking. The reason for that primarily sort of centers around its ability to drive economic growth. Banks are borrowing more or less on the shorter end of the curve and lending a little bit longer out on the curve. If you think about it, in terms of the average American, that really means the banks are borrowing kind of at that Fed funds SOFR rate, while lending, if you think about a mortgage, it's spreading off of the 10-year U.S. Treasury. So they're able to collect kind of that difference between the two. And that's really a sign of a healthy, economy and lending environment and growth, ultimately. The curve inverted, as you said, sort of coming off of the aggressive hiking by the Fed in 22 and 23, which peaked around 5.25 on the high end. Um, at that point, inflation was coming down, growth was really slowing, and so the Fed started this cutting cycle that we've seen since then. We've seen, as the chart shows, coming down from a short-term peak of a little over 5% down to kind of under 3.5% in terms of 2-year yields, and that's kind of where we want to see, particularly with 10-year kind of anchored at 4%, where we were at the same point, a year and a half or 2.5 years ago. But the 10-year, 20-year, or 20-year and 30-year have gone up quite a bit. I think part of that is probably due to the return of the term premium. To get into term premium without getting too into the weeds, it's basically the extra return that investors are demanding for holding longer term bonds instead of continuing to roll sort of short term notes. And that compensates them for a little bit of uncertainty around Fed funds, around inflation, things like that. Currently, we're seeing a little bit of elevated term premium, although it's come down a little bit recently. And that seems to be based around some uncertainty around the fiscal situation of the United States and the deficits that we're seeing, the impact of tariffs, government shutdowns, and geopolitical uncertainty and debasement kind of around the world. To that end, we've talked, just briefly touching on the government shutdown there. How has that impacted equity markets historically?
The short answer is that historically shutdowns have had limited impact on markets. And so we're showing the last 21 shutdowns, I think, dating back to the Carter administration in the mid 60s on this chart. And the bars indicate the return of the S&P 500 during the shutdown. Some of these shutdowns have lasted for a day or maybe two, and some have been longer. The one during the first Trump administration was almost 35 days, so that's about 5 weeks. But the average return of the S&P 500 during these 21 shutdowns is about 0.7%. So that's pretty normal, maybe even a little bit above average. So far, this shutdown has lasted, let me do the math here, about 22 days. I think it started on October 1st, so 22 or 23 days. The S&P 500 is up a little less than 1%, so just in line with average. What one thing that I wonder, when is the shutdown going to end? So you kind of look at the government's calendar. You got the next military paycheck on Halloween, October 31st. That could be one. So I think what's going to have to happen is there's going to have to be some sort of an increase in sort of social pressure on Congress members to kind of get it done, get their act together and compromise. So it could be the next military paycheck on October 31st, which is the catalyst. There's also the congressional staffer paychecks on November 5th. That's a little bit of a weaker case. I think this one might get all the way to Thanksgiving. But if we have a shortage of TSA workers and air traffic controllers during the Thanksgiving travel season, that could make things pretty miserable, and the entire country might get upset at Congress. And this could really put the squeeze on uh, on those members of Congress to kind of make the compromises they need to make to get the government opened again. So this one could be a record. It could be like 40 or 50 days, and the S&P could be up a couple percent during this period.
So, looking at sort of the rise here of gold, how much of that do you attribute to central banks around the world debasing away from the US dollar and dollar assets, and as well as geopolitical uncertainty?
It's a good question. Gold has gone parabolic over the last 3 months. It's had a sharp pullback this week, the week of October 20th through 2024th, but it's still in a massive uptrend. So I think I'm going to get back to debasement in a second. I think what's going on right now is that retail investors, ETF buyers have come in and sort of piled on to the momentum. But to your point, the sort of the backbone of the gold, relative gold price strength has been central bank purchases. And I want to pull that up. It's a little bit, it's not exactly the same as debasement. So I'm going to pull that apart a little bit. Why have central banks up there? And this chart shows the monthly or the quarterly purchases in tons of gold by central banks from 2010 through 2025. We have that dotted vertical line there indicating the March 22 US and allies freezing and essentially confiscation of Russia's central bank assets. And I think this really accelerated not, US or not, central banks outside of the US sort of risk management, to go back to a Fed term, increasingly important on their view to diversify their reserves away from one outsized holding, namely the US dollar. And so gold, and this has been led by China and to a lesser extent by other Asian countries, and even Poland, believe it or not, has been a big gold buyer. Gold, especially if it's held in the vaults of the home country, is hard to sanction or confiscate. So I think this is really a the driver of this to a large extent is central banks risk managing their reserves and to not have 50, 60, 70, 80% of their reserves in US dollars. Not that they think they're going to be sanctioned anytime soon, but you never know. The US, we have an election cycle here. There could be a new president with new kind of bones to pick in 4 years. As far as debasement goes, that's slightly different. This is the debasement is the concept of a central bank, namely the Fed or another central bank in another country, printing money essentially to monetize the debt. And so in this scenario, fiat currency, so paper currencies like the dollar, the euro, the yen, the British pound, over time, it's like an ice cube melting away the purchasing power of the citizens. So the theory goes that you would be more inclined to have more of your assets in things like gold or maybe even Bitcoin, and other precious metals, real estate, farmland, etc. I think there's some of that going on, but I think the big thing is central bank purchases, and I think that's the most important point here. And there's no, I mean, they might slow down a little bit, but I think it's unlikely that central banks are going to go ahead and sell their gold, at least in any durable sense, moving forward anytime soon.
So seeing here, it looks like Q3 GDP growth estimates are kind of all over the place, ranging from almost 4% to a hair under 0.5%. The average of that does come out above trend a little bit, around 2%. Are despite that, do you see rising gold prices as a reflection of market uncertainty regarding U.S. fiscal responsibility, or a sign that the government might run things a little bit too hot?
Yeah, I think there is some of that. Now, how are we going to connect the gold, the concept of gold to U.S. growth? I mean, yeah, I think it's a good point. I think that the Trump administration has pivoted towards promoting nominal growth. So nominal growth is going to be inflation plus the real level of growth in the economy. We're taking four estimates of current quarter, third quarter U.S. GDP. The high one is at 3.9%. That's Atlanta Fed. And then the low one is St. Louis Fed at 0.4. But I took a median. We took a median with a dotted line. That's 2% real growth. That's pretty solid for, especially if we go back, if we rewind the clock and our head back to spring when people are concerned about a recession because of, inflation driven by tariffs, and then just a complete slowdown in the global trade order. That hasn't happened yet. We think the Trump administration, I mean, we've pivoted. We've kind of gone through the peak tariff uncertainty period. And now I think the administration and the markets are starting to look forward to this fiscal stimulus that's going to be part of the One Big Beautiful Bill Act that's really going to come online in 2020, in the beginning of 2026. Probably got to wait till the second quarter. In the meantime, the consumer, especially the upper income consumer and upper middle income consumer, remains resilient. And then, of course, we have a fixed investment boom going on in a certain industry. And so all this supports expectations for pretty decent growth in the third quarter for the U.S. economy at 2%. And it wouldn't be surprising to see an acceleration of that growth rate at some point in 2026 to closer to 3%.
So to that end, as you know, we sort of see here, how much of this growth uncertainty do you attribute to being to pretty? A lot of this is driven, by one sector of the market, I guess.
It's a good point. The AI investment boom, depending on how you measure it. And so let's define the AI investment boom. It's all of these hyperscalers. So when we say hyperscalers, think Amazon with its AWS unit, Microsoft Azure, Google Cloud. Now Oracle has a unit called OCI. And then some people throw Meta in there as a hyperscaler, but essentially they need to do all this data center building to provide the computing power for AI training, model training, and increasingly inference uh, um, requests or inference demand, training and inference demand. And there seems to be, and we thought back earlier this year with the DeepSeek scare, there might be a digestion phase. Nope. We've accelerated. There's more companies kind of joining the mix right now. As I mentioned, Oracle is a new one, and we have these so-called neo clouds, the likes of CoreWeave and Nebius, et cetera. All this is added up to about 50, probably over 50% of the GDP growth we've seen in the first half of 2025 in the US is pretty much directly tied to AI. And so that's a fairly concentrated growth profile for the US. I mean, you can see this chart shows private construction spending, seasonally adjusted, billions of dollars, and we're annualizing it. We show data center with the gray bars, and then we see other areas of the real economy, lodging, so that's hotels, shopping center, and medical buildings, i.e. hospitals, education buildings, and amusement and recreation. And data center has eclipsed all of those in terms of in terms of spending at some point in 2024. So this truly is an AI investment boom. It is, I mean, an optimal scenario would be a more diversified set of economic growth, but that's not really how the real world works. I mean, capital and spending go to where the returns seem to be best, the future returns seem to be most rewarding, and where there's growth. And right now, that's AI, and that's probably not going to change for at least a year or two.
Yeah, makes sense. So to that end, with this surge in AI-driven optimism, do you view that as an illusion of market strength, even though leadership is narrowing to a small, sort of the same group of tech giants, like you said?
It's a great question. I think in a perfect world, we'd have a less concentrated S&P 500, but alas, we don't live in a perfect world. This chart shows over the last 35 years, the share of the S&P 500's top 10 companies in terms of market capitalization. That's the gold line, the brown gold line. And that's shot up to 39%. So almost 40%. That's about double from where we were in 2015. So the biggest 10 companies in the S&P 500 represent 40% of the entire index's value, and that compares to 20% as recently as 2015 or 2016. So that's unsettling for some investors. Like if you're investing in the S&P 500, it's, some people say it's a glorified AI index, and to some extent, that's correct. But that reflects the dynamics of the market and the economy. And so we just showed, the spending in real terms in this area. So it's not a mirage. Another point to make is that the share profits have also increased considerably, less in magnitude, but still considerable. So the dark blue line shows the share of the S&P 500's profits or earnings ascribed to the biggest 10 companies, and that number is 26% as of, I believe, 9/30. And that's double from about, well, a little less than double, but almost double from 2015, 2016. So there's a similar trajectory in both the size of these top 10 companies and then the amount of profits that they're generating. So from a high level, this kind of diminishes some of the concern because we've got the fundamentals to a large extent. It's not always the case, but to a large extent, keeping up with this explosive growth in sales, in market capitalization, and concentration at the index level.
If AI enthusiasm has driven sort of that extreme or at least pretty significant market concentration, where else might we see opportunities should sort of a rotation in the market take place? Maybe somewhere that's lagged the last few years.
Yeah, a lot of people are getting excited about US small caps here. And so what we're showing are various relative return comparisons for the Russell 2000, which is um, the broad-based small cap index versus the S&P 500. The chart on the left shows S&P 500 in tan and Russell 2000 in navy over various time periods. So whenever the navy bar is eclipsing the tan bar, small caps are outperforming large caps in that specific period. So you can see that's been the case for the last 6 months. But if you go back 9 months, 1 year, 18 months, 2 years, 3 years, 5 years, large caps have outperformed small caps. So recently we've seen some outperformance with small caps. So what's going on there? I think part of it is expectations of Fed rate cuts. I mean, we don't need to overcomplicate this. Smaller companies, smaller US companies tend to be more reliant on external financing than their large cap peers. Alphabet, Apple, yeah, they issue debt, but they don't need to. They could completely self-finance if they wanted to. That's not the case for your average company in the Russell 2000. So not only are they more reliant on external financing, but in many cases that external financing is variable rate in nature, so it floats. So high and rising yields or high and rising interest rates like we had in the Fed rate hiking cycle is very strong headwind, very significant headwind for small cap companies. And it works in reverse when when rates are coming down. And we've gotten some of that. And then there's also this resumption of Fed rate cuts after a 9 month pause. So that's blown wind into the sails of small caps from a relative performance perspective. And I think there's also this desire on the part of market participants to kind of rotate. If you can catch a small cap period of performance, it can be pretty powerful. Typically, they occur coming out of a recession. So I don't think that's the case right now. We could have a mid-cycle slowdown and then an acceleration, or they can occur during a significant period of Fed rate cuts, policy easing. And that's what we could be looking at that right now. I think at Main Street, we're still a little cautious on small caps. I think the Fed rate cut argument or the policy easing argument is a decent one, and it probably is going to remain in place for a year or two. But there are some quality issues in the small cap universe. Really, what we need to see is sort of a Goldilocks environment where inflation for small caps to outperform durably. We need to see Fed rate cuts, and we need to see inflation stay under control, and then we need to see the fiscal pumps kind of the fiscal policy priming the pump. And that it can be difficult to imagine a scenario where all three of those things come to play or manifest. The one concern I think we have is if we really do get, the Trump administration trying to run it hot to get nominal growth as high as they can to help bring the deficit down. You could have a situation where inflation kind of perks back up again, and then maybe the Fed needs to, and depending on who's at the Fed, of course, and the allegiance to the president, like they might be reluctant to cut rates further. That could be problematic for small caps. But in a healthy market environment, small caps would be in a fair competition with large caps. We have not had that for a long time. And so let me be clear, it is a indication of a healthy environment when small caps have periods of outperformance. And we could be starting one right now. So stay tuned. We'll have to come back around to this one the next quarter. All right. And so with that, I'm just going to wrap it up here with a little bit of an outlook. I divided this into things to be optimistic about, things to be cautious about, and then some of our expectations. So first and foremost, the Fed on the optimism side, on sort of the um, bullish side of things, the Fed has resumed its rate cutting cycle after this 9-month pause, which really was extended most likely because of the tariffs and what we thought for a brief period of time was going to be uh, the most aggressive tariff trade policy in modern history. It's not quite that, I would say, at this point in time. Next, U.S. consumer and corporate balance sheets do not appear in aggregate to be over-leveraged. There is some stress in certain areas of the credit markets. If we think about some of these high-profile bankruptcies, Tony and I think that's pretty isolated right now and fairly idiosyncratic, but definitely something to watch. And then as far as consumers go, it's the K-shaped economy. We've got upper income consumers continuing to spend along with their upper middle income peers, whereas middle income and then lower middle income are struggling. And from a societal perspective, not ideal, but in aggregate, that can continue to propel the US economy, along with the fact that the pace of AI capital expenditures and the related kind of energy and electricity infrastructure build out is accelerating. And that might change next week or next month or next quarter, probably not. But for right now, it is accelerating and it is a very significant component of US growth. On the inflation front, things have been milder than I think most people expected through at least August. As we mentioned earlier, tomorrow morning, October 24th, we're going to get the CPI data, which has been delayed for September. And footnote, I think the reason why they have to do that is because a lot of the Social Security payments that go out are benchmarked to inflation. So they're not doing it for just for the love of economic data. They have to do it to kind of keep the wheels moving with Social Security payments. And then last but not least, we have this capital formation and M&A percolation going on with IPO and merger activity like really picking up in recent months. There's a big I think deferred demand for that, and that creates kind of some animal spirits on its own and can flow through. It has an outsized influence on sort of economic activity. Notes of caution back to the AI CapEx cycle. Eventually, AI capital expenditures will slow, and there will be a digestion phase. This will be an issue for definitely the markets and to the stock market, and to a lesser extent, the economy. That's probably not going to happen by the end of this year, and it might not happen in calendar year 2026, but this is sort of a medium-term risk. We could see, although the clock is kind of running out on this, we could see inflation really accelerate due to tariff policy, and that could cause the Fed to kind of, say we're going to go back on pause again. Time's running out. Powell, like it's clear Trump is sort of halfway taking control of the Fed. And Trump's term ends in May, and that's only 7 months away. So we are getting closer and closer to the point, and Trump's going to nominate somebody that's very likely going to be aligned with his thinking. Lower rates are better in almost all scenarios. So the combination of tariffs causing inflation and the Fed pausing or even resuming hikes again seems increasingly unlikely every week and month that goes by, given what I just said. And then, of course, there's always geopolitical tensions in the background. I think things have cooled a little bit in the Middle East with some of the ceasefire in Gaza. There's been a lot of recent successful diplomacy. I think things are probably getting worse in Ukraine. There's been some back and forth between Putin and the Trump administration with threats in recent weeks. So I think the item to watch with that with markets is the crude oil price. Like if you see crude oil, moving sharply higher, up into the mid 60s, 70s, or even, sniffing out 80. That's the market saying like we could have an issue with, Russian supply, and that would be sort of the signal to, move these geopolitical tensions to the top of the list. Our expectations moving forward, there still could be an air pocket in American US GDP growth and the markets at some point in the fourth quarter, although time's running out. I would have thought we would have had some like seasonal weakness in the S&P 500 at some point. We haven't really seen it except for like a really short, shallow drawdown of like 2.5% after one of those payroll reports came in softer. But we think economic growth could ramp up and accelerate in 2026. So I think everybody should be sort of aware of that increasing possibility. At the same time, the labor market could remain softer than we might expect for longer than we might expect. And there's a couple things going on. First of all, as Tony mentioned earlier, we have the sudden change or the drastic change in migration policy has really cramped down labor supply. There's zero net new migration. So it's all, native workers that would be in the potentially adding to the, filling that back up the labor force. So we could have a scenario where we get pretty low payroll growth numbers, but the unemployment rate doesn't really get much higher than where it is right now. In that scenario, I think that probably gives the Fed air cover to cut at least 100 basis points over the next 12 months, especially if Trump gets his person in there to replace Trump. In this scenario, it probably makes sense that treasury yields, intermediate term treasury yields, so let's say, I guess 7 to 10, maybe even 5 to 10, stay in that comfortable range, kind of around 4. Once they get up to 5, that's kind of the market expressing some concerns about tightening financial conditions or sort of deficits getting out of control. But then last and not least, I think this is the big leave behind for everybody. The Trump administration well, which sits at the top of a unified, government, at least until, this time next year, potentially, they've pivoted from maximum tariffs and DOGE, their, 1 month half-hearted attempt at austerity, toward pro-growth fiscal and regulatory policy, deregulation. And so this mix, it should be growth supportive, and it should be risk asset supportive moving forward, especially as we get into, the middle of 2026. And so we want to position portfolios for that. We think that everybody should have a at least a neutral weight or full weight in equities. And don't be afraid of, fixed income. We don't want to be significantly underweight fixed income, but maybe have a little bit of cash and a little bit of gold in there if appropriate to help kind of offset some volatility. So that'll be it for us today. Let me show you the final pages here. I want to thank Tony for joining me on this call. We really appreciate everybody's time and attention. And if you have any questions, please reach out to your portfolio manager. Once again, thank you very much, and we'll see you next time.
Thank you.